Hey everybody, today we're looking at the banking system a little bit more carefully and more specifically looking at how the banking system creates money, it creates in quotes. All of this is sort of going to be very helpful as we move further in the course and look at monetary policy and decisions that the government can make to try and influence the economy. So specifically we're going to look at how banks create money and introduce ourselves to a concept known as the money multiplier. Before we get there, a little bit of vocabulary. So when money is put into banks, it's called deposits. And so the total deposits in the bank is all of the money that customers have placed in the bank. Those deposits can then be broken down into different categories. The deposits can either be loaned out to people or they can be what are called reserves. And reserves are simply deposits that have not yet been loaned out to the public. Now, the reserves can also be broken down. You have required reserves, that is an amount of deposits, a percentage of total deposits that must be kept at the bank at all times, and that level is set by the Federal Reserve, and currently it's at about 10%. The bank must keep that money in its vaults in order to facilitate the cash needs of its customers. Because if people show up at the bank and there's no money for them to take out, you can have some significant problems. And we'll talk a little bit later about that. They're called bank runs. And then you have what are called excess reserves. That is, reserves that they don't have to keep, that the bank could lend out, but they have not lent them out yet. And there's a variety of reasons as to why the bank might not lend out all of its reserves. Could be because they are concerned about the credit worthiness of customers and so therefore very careful with sending it out. Or maybe that they get better return by sending reserves to the Federal Reserve itself. And there's lots of reasons why they may keep excess reserves. But the key point here is that the money that is withheld by the bank or held onto by the bank, some of it must stay and some of it is their choice. The percentage that must be kept in reserve is called the required reserve ratio. That's the proportion of total deposits that must be kept in reserve. And again, the Fed sets that, and right now it's at 10%. The reserve ratio is a little more broad. That's just looking at what percentage of total deposits are actually being held by the bank. Typically, for most of what we're going to be dealing with in this course, we're going to be looking at the required reserve ratio for our purposes. Now, banks want to track where their money is going, coming and going, and either entering or leaving. And so they use something known as a T account. The T account is broken into assets and liabilities. Assets, as you may recall, are things of value that the bank can lay claim to and get paid for. And liabilities are essentially debts that are owed, and so that the bank has to pay back to people. So from the perspective of banks, deposits are liabilities. People put money into the bank has to pay them back their deposits, otherwise it's called theft. And then on the asset side, you have loans and reserves. Loans particularly because people have to pay the bank back for the money that they have been lent. And so we're going to use these T accounts here in just a moment to sort of track how the banking system is able to create, quote, create money through the lending process and through the reserve process. How do banks create money? In general, M1 is currency plus checking deposits. And so when loans are made to customers, it adds to total M1. An initial deposit that you might make at the bank adds more to M1 than just the initial deposit because banks lend out your money. So let's take an example. Let's say $1,000 is deposited at the bank. Let's say Andrew deposits $1,000 at Wells Fargo. So on the T account, you would see deposits would increase by $1,000 because there's $1,000 that wasn't in the bank before, now it's in the bank. So it's adding $1,000 in liability to the Wells Fargo bank, but it's also adding $1,000 to its reserves that it could lend out. Now, let's pretend that somebody comes along. We'll say Patrick wants to borrow $900 to purchase shovels from Sundriana's Snow Services. He's in a snow shoveling business and he needs to purchase capital. So when he comes and takes a $900 loan from Wells Fargo, the liabilities don't change. Wells Fargo still owes that $1,000 to Andrew who deposited it. But now it has new assets. It has a new $900 loan. So it's adding to the loans, but it's taking out from reserves. Patrick's going to use that money, and he's going to go to Sundriana's Snow Services, and he's going to pay her $900 to purchase snow shovels. She will take that $900, and she could go to her bank. Let's say she goes to Bank of America and deposits $900 into her bank, in which case, on the T account, there's a $900 increase in liabilities to Bank of America. It's $900 in new deposits, but also $900 in reserves. We could continue this process if we wanted to. Andrew puts $1,000 in his bank account. Sundriana has put $900 into her bank account. So the process is going on, and this may sound familiar to you because that initial $1,000 deposit has led to already $1,900 worth of M1. There's now $1,900 in bank deposits, whereas before there was nothing until Andrew put his $1,000 in the bank. This should sound an awful lot like the multiplier. In fact, there is a multiplier we call the spending multiplier, as we may recall, is 1 over 1 minus MPC. But we can also call 1 minus MPC marginal propensity to save. So we could actually write the spending multiplier as 1 over MPS. And so that's the personal spending multiplier. Well, banks have a multiplier with their money. And so we could consider marginal propensity to save as being similar to the reserve ratio for the bank. The bank has to save a percentage of all deposits. And so we could say then the money multiplier, just like spending multiplier, is 1 over the marginal propensity to save. Only we're going to call the marginal propensity to save for banks the reserve ratio. So the money multiplier here for banks is 1 over RR, or reserve ratio. Now let's do a little bit of practice with the multiplier so we can sort of see what to do with this information. So let's pretend there's a $1,000 initial deposit. We know with a 1% required reserve ratio then that required reserves would be $10. 1% of $1,000 is $10. The bank must keep $10 of that $1,000 deposit at all times. The remaining $990 of that initial $1,000 deposit is excess reserves, at least until it gets lent out. So as long as it's still sitting there unlent in the bank vault, $990 is excess, 10 is required out of the total 1,000. If we were going to measure the money multiplier, we would use the formula 1 over reserve ratio. And here, I think it's really helpful to avoid using decimals and instead use fractions. It's a lot easier, requires a whole lot less calculation. If there's a 1% reserve ratio, then we could say that the money multiplier is 1 over 1/100th. And so we take that denominator, 1 over 100, and we flip it. Sort of basics, second grade math. And so 1 over 1/100th equals 100. So this money multiplier is $100, 100. For every $1 deposited, we'll end up with $100 total in M1. So the maximum increase in M1 is the $990 that in excess reserves that can be lent out times the multiplier 100. So we will see an increase of $99,000 on top of that $1,000 initial deposit. So we'll see $100,000 worth of M1 when I deposit $1,000 in the bank. Now you can do a little bit more practice if you'd like. You can go ahead and pause and do some math and then unpause and see how you did, pretending that we have a 5% reserve ratio, a 10% reserve ratio, and a 25% reserve ratio. Assuming you paused and did the math, here's the answers for each of those, depending on which required reserve ratio you're talking about. As you'll see, as the reserve ratio gets larger, the money multiplier gets smaller. And this should make a lot of sense to you because, of course, if you have to save or hold on to more of every deposit, there's less to lend out, and so there's less available to grow. And so this is an important tool, or potentially an important tool when we get to monetary policy to understand that reserve ratio can affect the growth of M1 in the economy. Now, is the multiplier really as powerful as it appears? Currently, the money multiplier ought to be 10. If there's a 10% reserve ratio, then 1 over the reserve ratio would be 1 over 1/10. So every dollar should, in theory, grow to $10 in total. The reality is it's much less than that. The money multiplier is not quite as powerful as one would think initially looking at the math. Now, why? Simply because people sometimes keep cash. Banks keep excess reserves. Sometimes money is deposited and not immediately lent out to somebody else who then immediately spends it and hands it to someone who immediately lends it out again. So there are some breaks in the system that sort of slow the money multiplier down from what its theoretical level ought to be. Now, one final thing, and that has to do with bank runs, and this is why they have excess reserves and required reserves. The Federal Reserve was built because banks didn't always keep enough in reserve to meet the needs of its customers. And so back in the early 1900s, 1800s, what you would have is people would deposit money at the bank would lend it out, the loans would fail, the bank would lose the money, and then people would become afraid that they wouldn't be able to access the cash they deposited because they were afraid that the cash they deposited was now gone entirely. Once rumors start to spread within a community that the bank has lost your money, fear builds up quickly. And people realize that they need to get to the bank to pull out as much money as they can now before anyone else gets there, because if they don't, the bank is going to get left completely wiped out, and they're going to lose everything. There was no protection back in those days from the government for deposits. You could literally lose all of your life savings. And so people would literally run to the bank. That's why they called it a bank run. They would run to the bank to try and withdraw their money as quickly as possible in order to avoid losing things. Well, this is problematic. And in fact, if you want to see some examples, watch It's a Wonderful Life, watch Mary Poppins. Both of them have great visual examples of what a bank run might look like. The government figured out this is suboptimal. And so they created what's known as the Federal Deposit Insurance Corporation, along with the Federal Reserve, to protect people from losing all of their savings. So deposit insurance exists so that the FDIC guarantees at this point up to $250,000 in savings at a bank. If you put up to $250,000 in an account, if the bank were to fail for some reason, you would get all of that $250,000 back. If you have more than $250,000 in a bank account, first off, that's bad personal finance. But secondarily, you would lose anything over $250,000. Congress also required that banks have to have a certain minimum capital requirement so that, again, they would protect them from losing assets and failing. And finally, we have what's known as the discount window, and this is an issue that's going to come up in another couple of classes. This discount window is a way for banks to borrow from the Federal Reserve in order to meet their required reserves if they happen to fall below it. Again, it's just a mechanism to ensure that banks maintain liquidity and have enough cash on hand to meet the needs of their customers so that people don't have to freak out and run to the bank. So that's sort of the overview of how banks create money, and we'll talk more about it in class. I'll see you then.